Okay. All right. So as I said, we'll discuss to smaller extent in the slides. And then there is a separate agenda item where we're going to discuss at full length, and I don't mind going back. So welcome to the call. Your decision definitely, hopefully it helps you. This is an, so many people are joining, so I have to admit them. So let's look at today's agenda. What we are going to do is first review how the fund rate is going. Yeah, fund rate is the rate that Feds are increasing, right? 8 times in a year. And we have gone through last week on Wednesday. We saw that. Then we'll look at how the mortgage rate history in the last 22 years since 2020 or since 2000. Then we'll understand what actually impacts the mortgage rates, those factors, and deep dive into the Austin real estate data. So I did download all the reports from the Austin Realtor Board organization. It's a public data that they.
The meeting.
Can you mute Madhura? Can you guys mute if you're not talking? Thanks. So I download the data, and what I'm doing is I'm focusing on 2 counties, the Williamson County and Travis County, because that's where majority of us stay. And the counties that are excluded, they'll very likely behave what these 2 big counties are behaving. So you can assume that the data behavior is same. All right, so that's that. Then we'll compare how Austin was before or in last 4 years, starting 2018, how things were before pandemic, how are the numbers matching, right? That is to see, are we going in that direction or where are we right now, right? That's that. And then I have my insight. So I don't like to use the word recommendation because I cannot forecast future, right? But based on what I see the data, what are the insights, right? What is the sense that's coming out of the data, past historical data, recent past as well as past? And it is a complicated situation. It's hard to predict, but definitely things are expensive. We all know that. And there's a lot of anxiety and uncertainty. We are heading in that direction. And Powell also said he gave a feeling that there are uncertain times coming up. And so he himself seemed less confident on any conclusion. So he's going to continue hiking the rates. Then we'll have the group discussion. And this is where we'll discuss at length as a friendly group, right? We are buyers and sellers. So there's no lobby here. There's one Indian lobby. That's it. We are helping each other. But honestly, the group of 30, 40 is not going to make a difference in market also. So, and then there's a separate topic with Vijaya, one of our prime member in our group, TMC group, had suggested side hustles. Anything that we can do to make extra money, right? So we'll dedicate some time there too. I'm going to list out what you guys do to make that extra money, if any of you are doing that. All right, so I'm going to get started. So let's look at the fund rates. Before I do have a disclosures and disclaimers. I'm not a realtor, by the way. I'm not trying to sway or influence any decision, simply to go through the data facts and do the analysis, and then you guys do the evaluation and the decision. I'm just a facilitator of this discussion, and I did the data analysis based on the actual data out there. The data, monthly data is coming from the Austin Board of Realtors. Anyone can go get the data. And once you see the graphics, you will know you have seen this. So I downloaded this yesterday. And so it's fresh. It's not stale. And we have data till August month. Now in this data, they use median sales price. So median, if you guys know, is there are 11 data points. And if you do order them in a descending order, then the 6th data point is the median point, right? So it's looking at the median sales price. If there are 11 houses ordered in a descending price, then the sixth house is the median price. So the median sales price is, it's not 100% accurate, but we don't have any other options also because the data set is so huge. And each house could vary. The same house with a beautiful view in the back or a swimming pool will be more expensive when the square feet and the schools are same. So there is that variation too. So we have to use something. And that's what these guys are doing too. They're using the Austin Board of Realtors to use the median sales price to ascertain, to see how's the house prices, where are they hitting and what could happen, how is it looking 2 years back compared to 2 years and so on, right? So the assumption in this analysis is we're gonna follow or continue what they are suggesting, which is median sales price. There's no other options. We don't have any other data points. All right, so before we get started on the real estate, let's understand the Fed funds rate and then the mortgage interest rate. Right, so Fed system, Federal Reserve System, like in India we have RBI, they have FRS, Federal Reserve System, banking system. Basically at high level, Congress, right, the regulators are overseeing these three organizations, mini organizations with the FRS, FOMC. These are the guys who decide the rate hikes. They work with Board of Governors and then the bank itself. So these three guys basically report to the legislators, lawmakers. Lawmakers make sure that inflation is in control, economy is doing good, unemployment is low number, and the GDP is increasing, right? That's the goal. So FOMC meets 8 times in a year. And can you mute if you're not talking? Pramod, can you mute? And so if you see the Federal Reserve Bank.
Thank you. That way.
Can you mute? I want to mute you all. All right, gone. So all right, so Federal Reserve Bank, basically the biggest bank in US, loans the money at an interest rate. That interest rate is actually called discount rate. These guys give money to the commercial banks, but these banks have a reserve amount. They'll carry so much cash with them. When they run out of cash, if this is Bank of America and this is Chase, then they borrow from each other, and that rate is called fund rate. So Mr. Powell is part of FOMC chair, increases the fund rate, and then guys like us gets the loans at the higher or lower rates, right? So right now it's going up. So things are getting expensive on the borrowing side. But that's the big picture. No need to go deep inside, but this guy's FOMC meets 8 times in a year. So like they met last week, Tuesday and Wednesday. Wednesday, they announced the rate hike. And then now they will meet. They're not meeting next month. So they're going to meet in November and December. So the overall, they met 8 times in 2022. All right. So they basically simply set the target fund rates 8 times a year. They assess the economic conditions and then decide. So they assess, in this case, they assess the unemployment number, which is 3.7%, which is pretty good. That macro is good. But the inflation is still above 8%, and their goal is 2.5%. So they hiked again, right, with 75 basis point. And so if you look at the fund rate history since 2000, this is how it's going to be. It's going up and down. Now, most of us in this year, we have seen the rates are always going up. But if you see the history, in 2008, during Great Recession, the housing crash, the banking crash, there were a lot of rate decreases, 25 basis, 75, 50, and so on. So the line did go down, and it was almost zero starting with 2009 or so. For so many years, for 6, 7 years, this was really low interest period. You know, the Federal Reserve was giving money at a very low rates. But why were the mortgage rates not extremely low as we had in 2020? Because in 2020, after Corona, while Corona, government printed so much money also and distributed the money. So this is like saying interest rates are low, and here we have so much money to spend it, right? So that's the difference. But what I'm trying to show here is that these guys are not bad guys. They are also reducing interest rates at the right time. Here, there are a lot of foreclosures. So to stimulate the economy, they reduce the interest rates. This is during Corona. This 100 basis point, which was really big, March 16th. In just 10 days or 13 days apart, 2 drops. So they don't have to wait for another meeting. They did it right away. So 1.5% increase within 15 days, right? That was during Corona time. And then, as we know, they've been bumping up the rates since March, right? So we have gone through 5 hikes so far, 2 more to go. All right, so the current fund rate is 3% to 3.25. That's what it is. This is mapping to almost 2008 or 9 number. So right now, federal government, Federal Reserve Bank is giving money at the same rate as 2008, pretty high. And what is their goal? Their goal is by next year, they want it to reach to 4.6. They think when the fund rate goes to 4.6, inflation should be under control. That's their assumption. We don't know, right? So this is future. When a Fed says we are looking at 4.6, they have that in their mind, right? It's a certainty. It's not uncertain. So the knowns are they're preparing investors also. They're telling them that, hey, we're going to continue doing this till the inflation is under control. Inflation is, I think, 8.1% CPI, and their goal is to bring it down to 2.5%. So we have miles to go. All right. All right, that's that. And then once the fund rates is hiked or increased, what exactly happens? You know, what does it impact? So mortgage rate is not directly impacted by the funds rate, but the ARMs and the home equity loans are. Mortgage rate mostly is impacted by the bond market, and also Feds selling mortgage-based securities. So they bought so many from the banks during 2020. That's called quantitative easing or qualitative easing. And then now they're selling it back. So it's quantitative tightening. So when they sell and then the bond market goes up. So right now the treasury yield is going up, and that's why the mortgage is going up. But there is an indirect, you can have a correlation that when the Fed bumps up, very likely mortgage is going to go up, along with credit cards, student loans, car loans, CD, saving rates. Your bank will give you better interest rate right now. Right? And then the things that's not mentioned here is that the companies, industries, they are borrowing money. They are also giving more interest. Their expenses, the borrowing expenses have skyrocketed. So a smaller company who is struggling is now giving huge money back to the banks or lenders, and that impacts their profits. So it is very likely, if this continues, the small companies may go bankruptcy. That's very normal. So, and bigger companies, their profits will be impacted, but they won't go bankrupt, but they'll start layoffs. So the danger to continuous increasing the rates or rate hikes is the recession, because companies cannot survive high borrowing cost. All right, so that's a big picture. Now, let's look at the current mortgage rate. So I ran this yesterday, and see, there are numbers all over. So I picked one system which is kind of blessed by many, many orgs, which is Nerd Wallet. And that came back with 6.54 30-year fixed. So we'll use 30-year fixed as a benchmark for this analysis. So 6.54 is what it is right now, as of yesterday. Now, there are many Desi lenders and so many other small mortgage companies. They can get you 6.25 without any points also, right? But this is a US average, right, as of yesterday, 6.54. And so if you see the trend of last 3-4 months, this is how it looks. It's continuously increasing. And if I overlay the rate hikes, the 75 basis was, I believe, in July end. And so it went down actually to some extent, and then it came up. So usually there is not a direct, strong correlation with rate hikes, mortgage rates. But because the bond market is behaving very odd, the treasury yield has gone up, is climbing so fast, there is an impact. And whether we like it or not, it is 6.54 right now. All right. So well, how is that 6.54 over last 20 years? So we are, again, if I draw a straight line, we are almost in 2008 period. This dark gray or light gray block is nothing but it shows that this is when we had the recession. I'm not saying that 6.54 we are in the recession. I'm just saying it's matching the 2008 numbers. All right. So again, the question is, what are the factors that affect the mortgage rates? So in our case right now, inflation is causing the rate hikes, which is causing the bond market, right? And so it's causing the increase in the mortgage rate. Federal Reserve policy, they are selling the mortgage backed securities because they have to sell because they have a huge balance sheet, $10 trillion. So they have to sell back to the banks. So that could also impact. And then the market conditions, it was extremely hot and they are trying to cool down the demand portion. So Powell has said several times that he's trying to reset the market, right? He's trying to cool off the hot housing market. And he even said that he doesn't care. I mean, it seemed that his main focus in inflation and he wants to reset the housing market. And where he's a little bit concerned is recession. Of course, he's not going to overdo and bring recession. So they have to do the balancing act, but who knows? He may go for a soft recession. This is a danger control. I don't know, damage control possible, right? So that's that. So these are the factors. Right now, bond market is making a big difference. All right. Okay, so now let's talk about the real estate data with Austin. So as I said, I downloaded those files from ABOR, Austin Board of Realtors, and I'm looking at only 2 counties where most of us dwell. But at a high level, the August summary that I copied from their report is saying that the active listings did go up 170%, and the inventory is 2.9 months. This is the highest ever since September 2018. So things are piling up. Active listing is increasing, and the inventory is going up. And then the price increase or growth was less than 6% year over year since 2020. So they're seeing less growth rate since 2020. The median home price increased by 5.5 annually to this. And so the price is also setting its own record. It's really complicated. But they are saying this is very normal. All right. So now I'm going to go into the county by county. So let's look at specifically Williamson County. Right. So the house sales did go down 25%. Again, year over year. And I'm not going to read the whole thing, but median price did go up 8%, 475K. And if I bring up the graphic, this is how it looks. So this is as of August. Right. So a specific house on an average stayed 31 days in market. the price went up 8% year over year. So in 2021 August, it was 8% cheaper, right? 3,139 are the active listings. This many houses in August were on sale, and roughly the average was 3 months of inventory, right? So I'm looking at three KPMs or KPIs here: the sale price, active listing, how long it's staying on the market, and then what's the inventory number. All right, so that's Williamson. And this individual data will register in your mind, but you always need something to compare with, right? So I have slides on that. That's
Yeah,
where,
I have one question.
yeah.
So you're talking year over year. Can you tell month over month starting July of this year? What is the trend?
I'll show you. I have it for the whole year.
Okay.
Okay, so I'll show you. And that's what I was trying to say. Same thing with Travis. So Travis sales went down by almost 29%, right? But the median price did go up 8.6% year over year. So houses were expensive in August compared to previous year's August, right? By 8%. 27 days, average days on market, 4,000 active houses on sale, and the inventory is 2.7 months. Right. So we can see, if I have to conclude looking at these two slides, the number of days has increased and inventory has increased, but the price has also gone up. Compare over a year, not over a month, over a year, right? So now Nilesh asked, what is over 12 months or 6 months or whatever, what is over that 2022 timeline? So this is what I did. I basically copied PDF for each month, extracted these numbers, and rolled out here. So the yellow line is the Williamson, blue is the Travis. So in May, as you can see, we were really peaking the price, right? And then, so this was the maximum in this year. And then it did go down to 570. So I'm going to take Travis as an example. So 659 went down to 579, 570. But when I look at the last 8 months, 570 is roughly between February and March data. So in other words, if I look at the median sales price, Travis house prices are between February and March. That's what it looks like. Same or similar with Williamson. In fact, Williamson looks like February data, 475, 479. So peaks are gone in May, and it is going down, but we are still above January for sure for both the counties, right? And forget pandemic, this is this year. So if I overlay the rate hikes, right? So these are the rate hikes. So 25 basis point, still people were buying, things were going up. And after this 50 basis point, and then 275s, 75, 75, things are really, really getting expensive interest-wise. And what is that? So those interest rate, this 5.2. So what I did is I looked at the middle of the month. So August 15th or 14th, where it's a weekday, it was 5.207. Same thing with all these numbers. So mid of the month, these are the interest rates. And then the September is 6 point, whatever that number, 54, right? So September is not done, so I don't have the September median data. But this is what it looks like. This is a very important slide. I know you guys have questions. What I'll do is I'll come back to this slide and then we can discuss. All right, because I got a few more slides that may also help you. All right, so this is that. This is average days in market. So if you remember in May month, things were very pricey, expensive, and it was moving very fast too. 13 days. Now it's double, it takes double time to sell, right? Again, interest rate is a big contributor, right? So May month was very expensive and things were moving fast. And this
Yes,
is,
Nimish Bhai, this is Rajnikant here. I think one of the reasons could also be that people were desperate to get in before the schools begin. So they know exactly where to get into the schools, right? So
yeah.
that could also be one of the driving factors. One of the factors, not all the factors. But
And some of them were thinking, oh my God, the rates are going up. Whatever the case, I don't want to wait till 7 or 8. I'm just going to buy.
yep, the FOMO, yeah.
Panic mode. So good point. Active listings, this is it's stacking up. It's almost linear. Right. This is July and August looks like the same count. So whatever new guys were being added in July and August, they were getting sold also. But the residue is almost same, active listing. So this is showing upward trend. And then the months of inventory is also correlated to that. So remember this month of inventory. So we have 3 months and 2.7. Let's say roughly let's say 3 months inventory in both the counties, as compared to half months, 15 days here in January. Right. So, and we had inventory in May month too. So houses were expensive in May. Houses were moving fast. And the inventory also was almost 1 month. So a lot of people selling at high prices, and some houses were in the market for some time, and that's why that inventory went up. So this was a busy month. So if I compare today's mortgage with this, it's almost 1% went up, 100 basis. That's a big difference. All right, so now that is just this year. Those 4 charts looked at this year. How is it compared to 2018, 19, 20? So let's look at that. So of course, I was not going to put the median sales price because it's a disruptor in discussion. We all know that the prices went up, but we also know that on an average 5-6% appreciation happens. Of course, this is more than 5%, no doubt, no doubt. But these 3 numbers are actually more important. So in August, last month, we had 1 month of average days on market. But in August 2018, it was 51 days. 2019 was 54 days. So it's not bad in terms of average days on market. So if I put my house on sale, before pandemic, it used to take on an average 50 days. And now it's 31. So actually it's faster now. It's still faster. But the active listings are stacking up. A lot of houses are on the market compared to 2018. But on an average, they stay less days compared to 2018. And the inventory is almost same. It's quite similar to even with Travis. The active listing is higher. The days on market is less than 2018. So more houses on market now, but going faster compared to 2018.
Yeah, but time hasn't passed. Like if you take the September data, October data, this 31 days will become 60 days because nothing is getting sold in September. It's like that.
You're right.
We don't know, right? That's predicting
we don't
future.
know, but the trend is in that direction.
Right. The inventories are increasing. I agree. But again, if you see a lot of people are trying to cash out, if you look in the slides, people who have got appreciation are trying to sell in the market. That's why the listings have increased. Yes, those numbers will go up, but no one knows when September numbers come out or October numbers come out too.
But you talk to realtors, they are saying they were not able to do transactions in August, in September. So if you take a poll of realtors, they were not able to take the transaction. Those realtors which were selling 2-3 homes or 5 homes a month, they are 0 transaction in August and September. So what is showing? The trend is going down, but data is incomplete.
This is coming from the realtors data set. Nothing is manufactured here. You
And
see,
this is not
I'm
opinion.
not.
These are all
I'm saying
numbers,
is
right? Actual
incomplete.
sales.
Like if you go
oh
today
yeah,
is
but
August, if you go
I'm not
September,
gonna believe
October.
it. I'm not, Nilesh, I'm not gonna believe the hearsay. I want the data that says, yeah, they had transaction issues. Where is that
So
fact?
that's fine. Okay.
You know, because that will create a mind will get injected by that notion when we don't have the data that says that. You could be right. They may have system issues, whatever, right? But a house sale will not stop because the system was not rebooting or something, right? But if you see, so your point is right. Look, the trend is going up. There's no doubt. But if you see July and August, the delta is not huge. As if that people have stopped putting houses on market also to sell. This kind of says that they're putting brakes. Seller wants to wait. I don't know. That's what I'm deciphering. I could be wrong. So, but it could go up again. There could be a panic here. In September, that could be a panic right now. 6.5, oh my God, it's going to go 8 or 7. So they may buy. This 4,096 could become 3,500. I don't know. We'll see. I will update this chart. Okay. Right now, we don't know. I don't know. You could be right. I could be wrong. I could be right. Whatever. All right. So this is comparing to 2018. More houses on market now, but they're still moving faster. And as Nilesh said, this 31 could become 40. It could become 45, or it could become 28. Who knows? We'll find out. So based on this, these are my insights. I don't like to use the word recommendation. I cannot recommend. That's your decision. I cannot predict future with certainty, right? Inflation is still high. To tame inflation, he's not looking at housing market. He wants to reset it. He is looking at rate hike. And overdoing the rate hikes could cause recession. We don't know when that could happen, if it does, and we don't know how long it will last, right? The recovery is also important. Recession happens, people lose jobs, housing, the active listing will go up. One guy in a house loses an income, that house will be on market next month. That's a bigger fear. As we saw, August is August median sales price. So the house prices right now in August kind of matches February, March levels. And then this is 100% right. Since first rate hike in March, the 25 basis, from that point onwards, the active listings have jumped up by 5.5x. So it is going exponential. And that count has surpassed 2018 levels. So more houses on market now than 2018. But who will sell, who will reduce or lower the prices? Desperate sellers. Are they willing to wait 2 more months, 1 more month? Did they lose their job? Is there an affordability issue? Or some other issue that we don't know? That we don't know. How big is that percentage, that group? Right? But we can easily draw a line. If the unemployment goes up by, like Fed is saying, they are expecting 4.4% next year. So when that happens, absolutely, there will be more house added to that active listings. Right? But they are saying 4.4, it could be 5, it could be 4.1, who knows? We don't know that number. Go ahead, Ritzi, you had question?
Yeah, actually, we just heard a few in the discussion just passed. We heard about how we have data about closings, but I just wanted to hear from the realtors. I don't think we have active or accurate data for this, but maybe just hear, say, from the realtors in the group on how is the demand side? Like, do we have a lot of people who are still searching for homes, or we heard about closings, which is not really a whole lot, but what about people searching for homes? How's the demand side looking right now?
Oh, demand is definitely, my view is demand is definitely impacted by the interest rate. The PITI is much higher. Despite reduction in house prices, PITI comes out more. Many of these guys' loans are probably will not go through. So realtors can jump in. It's definitely cooling off fast. So, and based on what I'm hearing and reading and other markets too, it's not that people are not ready to buy a house. They're sitting on sidelines. They're paying the rent. And they're hoping that the housing market crashes or goes down by 20%, 15%. They want to see relief on the house price reduction. Go ahead, Ujjwal.
Just want to say that, Nimish Bhai, I know the housing price, yes, lots of investor, I'm getting lots of client inquiry. People want to set it up the LLC for their rental property, or, reserve the name for their LLC. So it looks like demand is still there. People are still investing. And, whenever I ask them, is your home is already ready? And they always say, no, it will be ready next year. So it looks like the demand is still out there, and people really taking this opportunity to invest whatever they have, thinking, one day the housing market will be back to what we see it before.
Okay. Balaji.
Yeah, the other factor is the inflow. We don't know whether the inflow is slowed down because a lot of tech companies are not hiring as aggressively as earlier. So that could also be another factor. Yeah.
Does anyone know our number of people moving to Austin? Has that reduced or stabilized, or the companies may not be hiring, but is the rate going down? And it has stacked up. So many people came and not everyone bought. So the pool of prospective buyers is increasing, but they're terrified by the interest rates. So at some point, my guess is they're thinking, I would rather just buy it now and stop bleeding on the rent and get that 6.5%, but looks like it's going to go to 7.5 or 8%. Who knows? That's that panic at their end. But this 4,000 active listings, if it becomes 6 or 7,000, as Nilesh predicts, that will also put pressure on the sellers. So
what has happened regarding renting? I did the analysis. The higher end rent has not increased much, but the lower end rent has increased a lot. Like suppose a house for 800 for one bedroom or 1,200, it has gone to 1,800 to 2,000. But in the posh area, if the house for 2 bedroom was 2,400, it is still 2,700. So the higher end rent is not gone too much high. So it's not people are desperate to buy. That was my analysis for past 3 months.
Okay.
Another, hi Nimish, one interesting, I would like to share my insight on the rental, because there is a concept. People always say, okay, if I'm renting a house, I'm losing a lot of money on equity, right? Because I pay rent to my landlord and that money goes to my renter's property. I'm losing on equity. But if that's true, because if you're living in a state where the property tax is 1%, that's definitely true. But if you're living in a state like Texas or Austin, for the fact where the average property tax was 3%, let's say you are buying a 500 or $500,000 or 600K house, you pay on an average of $1,800 property tax on a month, which is a liability to you, versus 2,200 rent which you're paying. So I don't agree. My personal opinion is I don't agree with the fact if you're living in the state of Texas, you are paying 2,200 and 2,300 rent, you're not losing a lot on the equity. But if you're living in other state outside Texas, yes, states where there is only 1% property tax, you are losing a lot on the equity. That's what I personally feel on losing the equity point.
Mani, I just want to mention one thing here. Correct me here. I was thinking the property tax can be, when we file for taxes, we can also ask for a rebate for the property taxes. Is that true or wrong?
It's an expense, right? So yeah, it goes against it. And just for the previous person who was talking about different taxes, I lived in Las Vegas before, so I had rental before, but rental in Austin is much higher for the same price of the house. So you may not be directly paying the property taxes, but it's baked into the rents. Trust me, I have both rentals in both.
Yeah, I just want to point something. Yeah, property tax is high, and Austin, especially Travis and Williamson County, has increased the value of your taxable amount. But if you go and fight, you do not have to hire anybody. If you go and contest, they are reducing by 30%. I know I have done my price reduced to 30%, and I know other people also. Just you have to go there and just contest. You have to put your argument, and they are reducing without any problem.
It's something to keep in mind when you're looking at demand and supply is that a lot of the people who are buying new homes, they don't do it just based on money, right? Renting an apartment for 2-bedroom and for the same price getting a 2-bedroom house is a whole different experience. So it's when you look at investments, or when you look at people who are only money minded, they will look at equity versus rent versus property taxes. But in the last this many years, many people who moved into Austin, most people who moved into Austin, they bought their first home not because it made sense for equity. They bought their first home because they wanted to live in a house, right? They have children that they want bedrooms for and places to move around. So I don't think that equity plays that much a part on whether I rent or not. Now, millennials are a little different. They don't care about equity. They just want to live obligation free. So they'll only rent even if rent doesn't make sense. Yeah. I think those factors are important when looking at, are people going to buy or not?
Right. I have a question here. So if I'm looking at an investment point of view, then how would it make difference for, if whatever the other person was talking about, taxes, and how is it going to, how is it going to make a difference for somebody who's looking at the investment point of view? Because I'm not sure if I want to live in Texas for long, or so, and I'm not, ready to buy a home just to live here forever, but I don't mind buying a house as an investment. So in that scenario, how will that work?
So there's this thing that they say, if you sell within 7 years, again, not the recent last 4 years market, typically the cost of expenses like realtor expenses and closing costs, everything, they say you need 7 years to break even in a normal cycle. But now all bets are loose. Again, next 2 years, prices may correct 20%, prices may not correct, prices may still stay strong. No one knows. So you're picking your poison, you're placing a bet, red or black. Again, right now, numbers aren't as lucrative. Again, people got lucky who had rentals before the pandemic. Again, everyone was worried that they'll lose their homes when pandemic occurred, but nobody can predict. Same thing with the stock market. So it's complicated.
Padmaja, you are on TMC, right?
Yes.
Okay. I have certain flyers for you as an investor also. I'll share in the group.
Okay.
All right, let me finish this, but that's good discussion. We'll continue this. So 30-year mortgage interest rate rose 90% since January. It was 3.44 and 6.54 yesterday, right? So one thing which I've heard, and it's a valid thinking, that if I get a cheaper house now, relatively speaking, if I get a January price, I'll take it at 6.54 and hope for interest drop some 2 years, 3 years, whatever that number is. And we all have done that, right? I'm in house number 3. I have refinanced many times. So it's not an invalid point. The thing is, we don't know when that rate drop will happen. and 6.5 may go 7, and 7 dropping to 6 may not be a big drop, for example. So, but it's not an invalid point, right? So if you want to buy a house with that mentality, I will not rule it out. You gotta have the affordability also. And I have certain points. It's not only math. It's, you go to the store and you see a $20 t-shirt and somewhere you saw 18, and you get stuck with that $2 thing. But you can easily afford $25 and go for it. So that's I've seen that. So the prediction with the unemployment rate, and this Fed's explicitly said it, they're preparing investors that they are expecting 4.4% unemployment next year. So 0.7% will go up. And we know that 65% Americans live paycheck to paycheck. So there will be 1.2 million jobs losses based on that 0.7 increase. One guy losing an income in a house in Austin will put his house on sale. I used to live in Dearborn, close to Dearborn, Canton, Michigan. And when Ford announced 50,000 layoffs all over the world, there were 5,000 houses on market next month because these guys live paycheck to paycheck. It doesn't affect Indians. We are pretty good, but it's going to flood the market if that happens. 4.4 is what Feds are saying. All right, so the risk with the ownership is mostly income, right? So we don't know the job market situation. And then companies will also be going through stress if the interest rates go up. So there could be some layoffs too. These are all possibilities. We don't know. No one can say it with certainty. And when companies start laying off, that's when the recession thing starts. And that's what that Ford example I gave. So house tax is another thing. People bought houses and yes, the houses, Nilesh, my assessment went down by 30% too. I live in Travis County and it was easy. No, not even back and forth arguments. So my feeling is house taxes will taper because otherwise there will be a lot of foreclosures with the house taxes. So my wife works in state and she was telling me they had to hire so many people because there are so many protests. And there is some political guy, some person who's standing in election, and he is really under pressure to make everyone happy. So, but already the protests are going very well. So, and so my conclusion on the insights, again, I'm not recommending anything, but what I feel is don't get lost too much in math. If you have money and solid, stable income, that's very important. Solid and stable income, not 6-month employment. If you have that, then focus on location, schools, and affordability factors. And most of the people I've seen, especially youngsters, they forget. They only look at PITI, but there's another few storms in your life, like retirement and kids' education and HSA and all that. So you need to do, when you do the math, it's not PITI, it's PITI plus 401k plus IRA plus 40, and this is over for years. So that should be the math used when you do the calculations. And of course, tax is a new thing. All right, so that is all I have. Now I can go back to any previous slides if you guys want to discuss. Let me go to that median sale.
Can you touch base a little bit on how does 5-year ARMs work? Someone, because I would like to know a little bit about ARMs. Like,
Ujjwal, can you explain 5-year ARM?
I can answer.
I
mean, I have taken 5-year ARMs in the past. So effectively, there will be a upper limit and also the maximum adjustments that can go after every year. Again, depends on the time when you buy it. You may get lucky or you may not get lucky. I got it for my house when I purchased it in 2004. And in fact, it never rose over 4.25. I had the ARM starting at 3.5 back in 2004. or 3.5 or 3.75, I forgot. But yeah, you can get lucky. And again, if you actually put in the extra money that you save based on the interest, you actually can get your down payment down. But again, depends. No one can predict how interest rates go or where it goes. You can get lucky or you may not get lucky. But you have a chance to refinance. But if interest rates stay longer high for more than 6 years, then you may not be of much use. But again, right now, both the 15-year, 15-year and 7-year arm or the 7-year arm are almost the same. So you could as well, if you can have the extra 400 or 500 that you can afford, you can as well get a 15-year and get ahead with it.
Got it. And sorry, thanks, Arun. One more follow-up question. Let's say the higher end band would be, let's say 1%. Let's say I take a 5-year arm, and after 5 years, it would be plus or 2% based on the current rate, right? At that point.
Exactly. Exactly. It's still a 30-year loan. Only thing is the first 5 years your interest is fixed, and after 5 years it's based on the market, and there will be also market plus 1 or market plus 2 that they would specify. I mean, touch base with someone who knows loans better, but based on my scenario, yeah, it was there was a limit and it couldn't go past X%. So the extra money that I saved, I actually put it in the house the first few years. So I actually got my principal down.
Got it. So usually, yeah.
If we are talking about ARM rates like 5.1 or 5-year fixed and then variable, there is a very important thing to consider, and this is what happened in the 2007-2008 market.
Yes,
the situation is that you get a low interest for the first 5 years or a better interest rate for the first 5 years. And then in the 6th year or 7th year, if the Fed interest rate keeps going up or has gone up and you're paying Fed interest rate plus 2 and you decide to refinance, one, you're only going to get the higher interest rate, right? It's going to depend on what the rate is at that time. The scenario is that if the house prices have gone down, you may not care as much if you are not in a 5.1 rate, because you're going to live in that house for another 10 years, let the price increase. It doesn't matter, right? Your primary home, the price goes up or down once you buy it. Since you're going to live in it for 10, 15, 20 years, the only thing that matters is when you sell it. But if you're in an ARM rate and you're having to refinance, a situation people ran into was the house price had gone down from 500,000 to 300,000. They still had a loan balance of 350. Even after 5 years, right, all the payments, and then they're trying to go to the bank and say refinance. The bank's saying, well, we will refinance at 80% of $300,000. Bring the rest of the money to the table. And people who needed to bring their interest rates down, even if the interest rates were down, because the prices of the houses were down, had to put $100,000 additional on the table to get a refinance or keep the high interest rates. So something to be careful of, that at the time of refinance, you need your house market stable as well. Otherwise, you're putting additional down payment at that time. Now, if you have good income, right, if you think you can support that because you have other income on the side and stuff like that, then that's fine. It's for the people who may not have as much money at that time, if that condition happens.
So I'll inject one statement.
Nimish, sorry to cut you off. I have a question for this to Hemal. So yeah, ARM has that difficulty. I understood that. Thanks for pointing that out. But what if we went for 30 years fixed, and even then, if the housing market didn't do well and we wanted to refinance with the lower interest rates, even then we have to make up for that equity, right? If ever the house prices went down, that danger is there with both.
But you're not required to refinance at that point, right? You just wait. You comfortable with the original interest rate, you could afford it, you continue to afford it, right?
Okay.
And you wait until they go down. But otherwise, you're in a fix saying, hey, my interest rate. So in your case, you have a max, but many ARMs don't have a max, which means people were in a situation where they got a loan at 4% or 5%, and their interest rates had gone up to 10 because the interest rates were increasing, right? This is 2007. And so if there were people who were like, why? Now my interest is 10, I can refinance and get it down to 5.25%. And they couldn't because they had to put the money down. Now, if at the time of getting ARM had they got a 30-year, then their interest rate would still be in the 6-7% range, not in the 10% range, because after 6th year, your rates go up.
Okay, that makes sense. Okay.
So just sharing, in 2007, 2008, we were all here in US, and the biggest complaint was the ARM guys. And of course, the US regulators also improved the laws, and they tried their best to improve the situation. But in 2007, 2008, wrong people who were not eligible to have those houses, got the houses at a low interest rates of these ARMs. And when the rate went up, it was horrible. And then there are a lot of lessons learned. My suggestion is peace of mind, 6%. Of course, 6% is high right now. In the last session before 6 months, I did this similar Zoom call. It was 4.5 at that time. But I'll acknowledge that no one can predict what's going to happen in future. So 6%, 30-year is peace of mind. 5-year ARM, 7-year ARM, you will be curious what's going to happen at the 5th or 7th year. So, right. Someone raised a hand, a couple of guys.
I just have one quick thing to add. So what Hemal said was correct, because I was in Vegas at that point, and I knew people who had ARMs along with me, but they had the scammy ARMs, which was which I don't think exists anymore. And whereas I got like a proper ARM through proper verifications, not a ninja loan. So those guys had a teaser loan, and afterwards, like the interest rates jumped, nothing with regards to prime. It just jumped up like 14%, 15%, 13%. So they were set up to fail. But yeah, if you get a proper ARM, since they reflect based on the current market rate, I mean, there wouldn't be a need for refinancing. But again, you're at the whim of the market rates, so whatever the rate is at that point.
Yeah, Arun, I have to admit that I have not researched ARM rates recently, and so the offerings may have got better where they can't put you in that situation, because that was a big deal in 2007.
Yeah, it did occur to me. Yeah, but I know people who got affected and lost homes back in 2008. I totally forgot about that because it wasn't applicable to me. But when you raised it, I just remembered. Yes, I knew people who had faced that. Yes.
Yep.
Yeah, I just want to add one point, right? I think I just put 3 points in the chart as well. So if you look at it, definitely 30 years going for fixed rate is good. There's no, I mean, it gives you peace of mind. But also you need to look at your own state, whether it is a starter home, what's the average home you want to own that. And then typically as the family grows, you upgrade. And the key thing here is you have to look at the amortization table. Sometimes you pay a lot of interest upfront. Let's say after 5 years, even if you refinance, you lose money. So all those things you need to probably dig a little bit deeper and make the right call.
That is good advice. So in my cases, we paid off all the previous 2 houses every 10 years.
Yeah.
But my first house, I'm just sharing here, 2000, my APR was 7.52. The problem this time is the APR is going up and the house prices are super expensive. So ideally, you guys should be, if you're getting a 500K house, anything around 6 or below 6 is the ideal, with the hope that when it goes 4%, you will refinance. I don't think we're going to go to 3%. That's not going to happen for sure. So reset your expectations. 4-5% is excellent number. 6.5 may look fantastic against 8. Who knows? So
yeah, the only time it goes is like when no one's willing to buy is because like you have like a really bad recession or you have the next pandemic. But again, those are situations nobody can predict.
But if you look at the housing, if you look at the sentiment out there, it's not optimistic. It's very pessimistic right now. That's why stock market is down, housing is down.
Right. And again, housing lags a little bit. So lower prices definitely will come in the future. Don't know when it's going to happen, but if the interest rates stick, housing will get softer. And also, even this time, housing is not the center of the issue, right? Like 2005, it was bad loans, the systematic things were failing, banks were failing, and it started in 2005. The recession happened in 2009, and real estate prices bottomed out in 2012. It took 7 years. Not saying it'll take 7 years again, but cycles are larger than what we think. I mean, yeah, it may correct 50%, but not in the next 1 year. May take longer. So yeah.
And inflation is the main thing.
Exactly.
That needs to go down 2.5%.
Right. But again, the thing is, like, salaries have already gone up, at least for unskilled jobs. The middle class, like at least the tech jobs, that we haven't had that much raises, but people working unskilled jobs, I mean, Runner City charges $30 to per hour, and that's the minimum. Usually you need $40 to get someone to your door for any unskilled job. So that was something that people used to pay like $15, $20. So yeah, some of those things I don't think is coming lower. Same thing with construction costs. Yeah, materials may come down, but labor, I don't think people will go down. I don't know. It's hard to predict.
No, that's what they're saying. Service inflation, wages inflation.
Yep. That's the next one. Yeah, exactly.
In the last meeting, last Wednesday, although he did mention that there is some cooling off in the wages inflation, but somebody working at $20 an hour is not going to take a $15 job. So
yep. I mean, everywhere the job minimum wages have risen up, right? So it's like 20. No one's going to work less than $20-25 anymore. So
right now, if there's a recession, if they lay off so many workers, then somebody will be willing to take. It's a supply demand, right? Same thing.
Yeah, exactly.
So recession could be a reason, could be a catalyst to lower down all this inflation.
I mean, that is the only catalyst. There is nothing else that can bring down inflation. It's recession, because more money was chasing few goods because everyone had money. And that's why the whole supply chain issue started to begin with, because everyone had money, everyone was spending, and no one was manufacturing. So it all started. But it's one of those things. Yeah, recession is the only way. And as much as people hate the interest rates, even as homeowners or buyers, people in the market, I think it's one of those things. It is better to get it done rather than having something like what we had in the 80s or what Japan has had for the last 2 or 3 decades. So, so it's high inflation. Yeah.
I have one question, just on a little bit side tangent to this. So I just want to get some views from some experienced folks over here on the discount points. Like, I'm not sure, and I'm not able to calculate or basically do my analysis on that. Like, how much worth are the discount points? Like, say, for example, if I have some extra bucks to spare, is it worth taking the loan percentage down by paying those discount points? Or I'm in kind of like dilemma, like whether I should bring down the loan percentage, say like if I'm looking for a horizon of 5 to 6 years, shall I use those money to bring down the interest for a 30-year fixed loan to like say 0.50% down from whatever I have fixed or whatever I will get it, or rather I should just pay those money to my principal and bring my principal down. So I made some calculations over that for a horizon of 5 to 6 years. And like if I use those money towards discount points, like at the end of 5 years, my kind of like outstanding balance was hardly about 2 or 3K less than what it should be without discount points. And like basically if I utilize those to directly pay the principal, it was making a difference of 10 to 15K over the horizon of 5 years. So I'm kind of like under it.
Okay, go ahead.
Yeah, so I was kind of like under a dilemma, like whether those are even worth, or I mean, definitely if you look at the horizon of 10, 15 years, it's definitely worth. But what I think like is eventually like maybe, I mean, it's difficult to predict, but in say like after 5 years or maybe in 3 or 4 years, interest rate goes down, definitely refinancing is something which I'm openly looking for. So
you basically answered your question.
Exactly.
Yeah.
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 You will refinance. I'm telling you, Arpit, we discussed all these things when we were young, and suddenly a reduction in 2% interest rate in next 5 years completely changed the mathematics. So
one of the mathematical ways to do this calculation is to keep everything constant. Like, don't, in your case, Arpit, do the calculation using, you put the same principal, same down payment down, and look at how much. So with the discount points and without discount points, let's say the monthly payment goes down by $50, and for discounts you're paying $2,000. To get the discount, let's say you're paying $2,000.
Right.
You recover those $2,000 in what? 2,000 divided by 50. What is that? 40 months?
Correct.
Yeah. If you plan to live in the house more than 40 months, like if that's your best guess, then it makes sense to put $2,000 now and get a $50 less monthly payment. If that comes to 10 years and you think by 7 years, I will most likely move out of this house, buy a bigger one, then it does make sense to buy it, right? That's how, and then once you have the, yeah.
Go ahead, sorry.
Yeah, even then the
No, that's
points.
That's precisely what my banker said. When I bought, he said, if you buy a 0.25%, it takes about 4 years to even break even. So that's exactly the calculation, 40 months approximately to actually even break even that point. So if you're going to stay for longer than,
and again, at that
7
point,
years,
it becomes about flexibility versus another $50 more. So
like
pick your poison. You don't know how things are going to change. And sometimes it's okay to not get it because again, you putting it, I bought points in the past, but again, I never refinanced, but it doesn't really matter. End of the day, for $50, I'm spending a few thousands, like 4,000 or 5,000 to start with. So I don't know.
How about kind of like I go and put that in principle directly? Like,
yeah, I mean, anything you put down in principle will speed up your payments. So yeah, anything you put, Ian, I used to do like 10,000 every year, end of the year, whenever I got my tax returns, I used to put it at my house. Again, different people have different strategies, but yeah, you can, some people put in an extra, switch to bi-weekly or make an extra principal payment once a year. So yeah, people do different things. So yes, whatever works, paying down principal means, because initially, if you see the amortization chart, you're just paying like $200 or something very low, and it's kind of snowballs as time goes. So anything putting down more right now will help you pay off the loan sooner.
Definitely makes sense.
Yeah, Arpit, don't sweat a lot on $2,000, $5,000 savings over 500K loan over 30 years. Let's look for 50,000, 100,000 savings. Pay principal faster, one extra payment in a year or $200, $300.
That's where actually I was confused, like whether I should basically bring down the interest right now. So to be honest, my house is going to get closed in November, December timeframe. And I've already logged the interest rate right now at 5.25 for a 6-month lock. So that's where I stand.
I have an Excel. I'll share the calculators. You punch before and after. If
Got it.
Delta is $2,000, you're working too hard for a small amount. So there are more avenues to save more. And I'll show you that.
Got it. Because
just to add, when you file your taxes, also if you're paid points, it brings your taxes as well. So I mean, it's not one magic formula. I think Nimish already said he'll share Excel, right? So you have to look at all the variations and combinations as to what really makes sense in your particular scenario and take the best bet. And again, it's very hard to really come out and say, hey, this is probably the best way one could take it. Yeah.
Right. I'll have a session with you. All right. Anything else before we jump on to this? Is this helpful? I mean, here's what I'd say. Look at the sentiment. Are you comfortable buying a house in a US economy, possibly entering recession? You also need to invest in peace of mind. So you have to think that, will your job be stable? Do you see your company stable after 1 year, 6 months? This is a commitment over many years. So you got to be happy in that house too. So think from all perspectives. So
I have one question. So if there are two scenarios where in one of the scenario, the home price is reasonable, but the interest rates could be high, or the other scenario is maybe the house price is higher and with very good interest rates. If we have to, pick one of the scenarios where which is a better scenario to buy a house?
you have to
definitely the lower price, but again, these cycles last for decades, like 10 years or 8 years. Are you willing to wait? It becomes the next question. There's no right or wrong time. It's how you manage the situation and how much, again, if you have more down payment, you would probably go with a bigger down payment, even when the price is high, and keep your interest low. If you plan to refinance, so there are different ways you would do. But again, the market gives you only one thing. Right now, it's higher interest rates. So you would think with that perspective, right?
Yeah, let me tell you this, the total cost of ownership, you have to assume that there are two parallel loans of 30 years. And if you look at total cost of ownership, interest rates is very expensive than a reduction in house price. Even a 10% reduction in house price will not make a big difference as compared to 1% increase in interest rate over 30 years. So I have that calculator also. Padmaja, I'll share it.
Nimish, could you repeat that? Sorry, please. I couldn't follow that completely. Could you repeat that statement once again?
So two scenarios, right? Somebody, like right now, someone says, I'll knock down $10,000 or 10% of this house. So you're happy, right? So $500,000 house is now $450K. $450K house at 6.5% as compared to $500K at 5%. $500K at 5% will be a winner because the 1% extra or 1 or 1.5% extra that you are paying for 6.5% loan will cost you more over 30 years than $50,000 reduction. Right? So if you remember 6 months back, I had shared that Excel and I have that here. I'll show you. So real estate Austin right here. So this is an example I did, and there was a lot of fiction, and now actually it's coming closer. So in January 2020, you had $500,000 house that went up 29%, and that's an actual number. So it's 645. January, it went up 725. And then 1725 went by a reduction, 652, 580, September 507, right? So these are pretty high numbers, actually. If I look right now, I think the reduction is 15%. But see, this is the total cost over 30 years, right? So the interest rate is 6%, 3.1%, 4%. Interest rate is also going up as they're increasing so you have to look at the TCO values for each scenario. You are having a house reduction of 20%, but your interest rate went 2% up. It was 4% previous month or 3 months back, and it's 6%. So actually it's expensive. Even though the house went down 20%, 652 became 580, but your interest rate went from 4% to 6%. You're end up paying more over 30 years. So you have to assume, right, the same scenarios for both the comparison. 30 years is what I'm assuming.
Yeah, but we can refinance it anytime in future.
Yeah, but we don't know what is that future. First 5 years is your biggest loss, or first 10, 15 years of a 30-year amortized loan. So that what you're saying is right, but 6% will not become 4% overnight.
And Nimish, I think the statement about we can refinance it anytime actually is you can refinance it. You will refinance it only if the rates are lower.
Yeah.
But something else to keep in mind is refinancing comes with a cost. Just like we did that discounts calculation a minute ago. If the refinance is going to cost you $3,000, and bring your interest down, your monthly payment down by $30, you're still looking at 100 months to recover that. So it's not like you can refinance any time, right? The interest rate has to be low enough to pay the closing costs.
Yeah. So let's.
Yeah. So if you
One
see
thing
the
is there is
interest
no
rate
guarantee.
over 50 years, it is averaging around 4%. So eventually it will come down to 4%. I'm not saying it will come down to 2%, but eventually it will be around 4%.
We don't know.
15 years? Yeah. Can you move it to 50 years? Can we see where we are?
50 years?
Yeah, no, the interest rates, people are seeing like the last 10 to 15 years, right? But historically, interest rates were always above 6. Again, I'm not saying it will go up over there, but nobody can predict where it is because in the past, when
it used to be 20% in 80s.
Exactly.
Yes. But for few years, if you say the average, it is coming around 4%.
In last 20 years, yes. But I mean, we can sway the math our way. My answer is I don't know. But let's look at the math I'm saying. So in January, this is a perfect number. In January 22, so start of this year, the house was for 725K. And now the guy knocked off 225K. So it's 507. In January, the interest rate was 3.1. Now it's 6.5. So the total cost of ownership is 1,000,020. And here it is 1034. So you know what I'm saying? I'm saying that don't get happy by this 200K reduction because the real culprit is this guy. Now, of course, we don't have a control over this one, interest rate, but this is the math you need. If Arpit is discussing that way, then he needs to look at total cost of ownership.
So I have one question here.
Yeah.
So apart from Austin, everywhere in other town, the price increase was normal. In Austin, people started moving due to the pandemic. Oracle moved, Tesla moved, some other Samsung opened a new plant. So people started moving here. But eventually, the rate will be coming. Will be coming pre-pandemic level. Like they won't be increasing the way it got increased in pandemic. So things are going to normalize. It may take a year, it may take a 2 year, but it will be coming back to normal.
How do you mean when you say Nilesh, I think what I would, it is your opinion, right? And all of us have different opinions, but if you look at markets like Denver, Charlotte, Phoenix, California, they had similar scenarios as Austin. There have been many cities, almost all cities where people want to live have gone through something like Austin. Now they may be a little bit behind, they may be a little bit ahead. Same thing with Tampa. Every one of them went through a similar appreciation as Austin. And the 4% interest rate, I think that's a risky statement to make. People were very comfortable with 5.5%, 6%, 7% interest rate for a good number of years. When somebody tries to take an average over the last 50 years, I think they should take out these years, the last I would say, almost 7 years where the interest rates were below 4, and then average it, because that was never heard of before.
Okay, so I have one counterpoint. You are saying it's not my opinion. The price of a house in the city is defined by the salary in that city. The high-end salary or average salary depends upon that.
So,
the Austin housing market is increased so much. Sometime it has become double in early 2001 from prices in 2019, but salary hasn't increased. So why Indians are able to afford? Because everybody, both the members of the family are working. That's why they are able to afford. But that's not going to guide the price of the houses in long term. Eventually, it has to be based on the salary people get in this area. Is not that right?
But again, 50 years ago, California had the same thing. People thought it was overpriced. Not saying this is going to be the same. And things don't change. And again, another thing is, yes, salaries will increase eventually. A lot of places like Denver, it was raised. I mean, they're still going strong. Even Austin too. You're seeing 4 years. 2009, a 100K house went up to, again, it took 10 years, but again, at 2018, it doubled. Okay, a lot of other states didn't see that because again, salaries went up too. Eventually, salaries catch up. Everyone's working remote, companies are coming. Can we definitively say that things will go up still? Nobody knows. But the thing is, chances are where there's talent, companies come. Where there's companies, people come again. And yeah, two people working, one people working, that's immaterial. But the trends are trends. Nobody can predict where it is. But again, if there is it's a ecosystem where there are employees, companies come. Where there are companies, employees come. So the chances of it sticking is higher than things going the other way. But again, nobody knows.
I can say this, that the people will filter out, people will move out if they cannot afford Austin. And basically you have 30 offers, so you're gonna sell house to only one guy. It's that thing. Basically, guys who can afford will stay in Seattle. Guys who cannot will move somewhere else. Same thing with Austin. And employers will get the quality people, then they'll have to pay. So you're right, 2 income is needed for $1 million house. But if they could not afford, the loan system will not approve that loan too. So, my guess is 5-6% could happen, but we don't know. It could go 8%. We don't know what is future tomorrow.
No, in general, I just want to add one point, Mishbhai, is see, in general, probably when you came to US 20 years back, your approach is different, home buying, all that, right? Now people are very aggressive because if you put 20% down, you see gains on the 100%, which 80% of that is given by bank, right? Whereas if you in the stock market, you get gains only on the 20% whatever you put, right? So that's the key here. So for long-term investment, house is always better. But at what point invest depends on your own circumstances, all that. But see, it's all demand and right. There's no relation to salaries, all that. Definitely, the affordability will be high, but in the end, it's all demand. How many people want to invest if this is the right investment vehicle, right?
Right. And one more thing is the same, I would just say people complain about the high house prices, but if the same house prices are right now offered at 3-4%, nobody will complain because the PITI, the payment will come way down with that lower.
No, there's no relationship to salary because I lived in San Diego for 20 years. Even 1,500 there is 1.5. Where is the relation for salary? Nothing. So you just need to afford. You can't afford. You get the money from India, buy it, and it will appreciate more on the 20%. I mean, on the 100%, but you only put 20% down, right?
Okay. All right, guys. I'm getting requests to jump on the next agenda item. So.
Can I quickly mention one point, not relating to this discussion? This was a very helpful discussion, but when we do this in future, can we also add a slide or something for people who just recently moved, are interested in the housing market? What are the areas that we should be looking in Austin for somebody like me who recently moved? It has been a challenge just to identify good areas. If we have some information on that, it would be very helpful.
Sure. North Austin is good. South is good. West is good. East is not developed. That's for sure. School districts, Eons ISD is number 1. I think Leander is 2nd. That's all on the Indians in Austin welcome package. I don't know if you have seen that.
I have seen that, but we are in West Palmer.
We need to discuss. You're right. Why don't you do this? You remind me in an instant messenger someday next week. I'll set up a Zoom call for new guys.
That would be very helpful. Like going down deeper locals like Avery Ranch or Bushy Creek or Cedar Park. I mean, I only know about these areas, but there must be more areas that I could look into and expand my search.
Yeah, even might be go to Georgetown and those districts as well if your kid is still not that much big. That school is not an issue. But I really appreciate Nimishji on that part.
Yeah,
translation
for that I need
for
realtors because they know about the areas very well. So
and to all realtors, we are still looking to buy houses. If you could just spend some time with Nimesh ji, help us out. We will.
okay.
Yeah. I will.
We are here to help.
Too.
Yeah.
I too would request the realtors here to help.
So one thing I'll say is I'm gonna also have a basic financial planning Zoom call next week, probably this time. This is the big picture, the PITI plus 401k plus IRA, that long line I mentioned. That is very important. We are just stuck in these walls, the brick walls and the lenders. But the journey is over 30, 40 years. And this is a generational change you will make even in your kid's life. So that planning session, Zoom session will happen next Sunday, 2 p.m. So I'll post it in our group. All right, side hustles.
Thank you.
Oh, yeah, you're welcome.
Thank you.
So side hustles, we want to know how do we make extra money easily? First of all, let's start with easily.
Easy.
I know there's Uber option, then Toro option. So Ritesh, are you here? Ritesh Bantia? Okay. Who can, there are a lot of folks who want to make that extra money and hopefully use for this 401ks and all that other stuff, IRS. So there was a request from Vijay.
Yadgiri here from Detroit.
Yeah.
One of the side hustle I see is like decorating for events.
Event decoration.
Spending like event decoration that is becoming popular here.
Yeah, actually, I heard about it a lot. I had no
And
idea.
then,
I just
at least
studied
in
last
Detroit,
week.
the next one is the DJ. You know, for the events, you own some music system, DJ package, and then those are of shortage here. Not many.
Anyone has done renting?
And anything about the event management, not from the perspective of end-to-end, but probably somebody like is organizing an housewarming party. They don't want to go into the hustle bustle of getting the caterer and all those stuff, and because I am one of that guy, I probably want to do that side gig, event management. From the Indian mindset, obviously.
Yeah, wedding planners. We need wedding planners, photographers. There are a few event management people in our group. I've seen them posting, which they were not there 2-3 years back. So I do see some expert in that area. Anu Narang is one. But we need more. DJs, I've seen many. But Toro rentals, like Ritesh Pandya is in our TMC group. He rents one room of his house. Then he bought 2 houses. He rented those 2 houses. And now he's into cars. And so he's...
Turo is for cars only, right?
Yeah.
Okay.
Turo is for cars only, yeah.
TURO, yeah.
TURO, yeah.
TU? Okay. Yeah.
Yeah, it's TURO. I checked last week.
Right. So he's doing this too, and the numbers I got were impressive. 700 a month or 1,400 a month, something he said. Because there's a shortage of cars. So, and he was renting his own car, and then I think he bought and added to his fleet. So that's one. What else?
I can give some context. I also have put one of my car recently on it.
Oh, Sachin, what is your last name?
Yeah, Sachin. Singh, last name is Singh.
Do you mind sharing your number?
Yep, 769
Mm-hmm.
233 9554.
Okay, thank you, Sachin. So can you shed some light? How is it? Is it easy, bothering, good, bad? How's the experience?
Yeah, it is. It's initially it sounds easy, but like everything else, it is not. Especially 2 things to keep in mind when you put your car on Turo is that one, you should not love your car anymore because you're renting it out.
Like any other rental, right?
Yeah, so you should
the love
come
you
to
put in
terms
your
with
home.
that.
Yeah.
And then the other thing is you should I mean, like I do a full-time job, obviously. So you should keep in mind how, like there are two ways. If you offer pick drop-offs and locations, like you can go and drop the car in airport or arrange an airport pickup, then your car is up for rental more, right? Because obviously that's where people are. So that is one thing to keep in mind. And the last thing is, you with your car, you should figure out a way to identify who you're giving to, because there is a good possibility that people would create damage, or like my car has been in some small minor scuff, big sorry, big ones.
Vandalism too.
Yeah, and you should
change
basically
car.
Yeah, you should not be psychologically affected by it. You should look at it as a claim process and go through that. And sometimes I feel it is too much. I will not do it. I'll stop doing it because I have to dedicate time outside the work. But I think if you're able to figure out, like, filter out the people, Turo has an option that do not allow anyone to book your car, but go through an approval. Basically, the request and you have to approve, similar to Airbnb. So I learned that later. I put that on, and then I try to look up their ratings, or I would not rent to anyone who is renting it for the first time because I don't know what they're going to do.
Sachin, I got one other question. I mean, again, I have a little idea about Airbnb, like what areas work, what areas don't work. So in a nutshell, Turo, if someone wants to do, does it work if you're closer to the airport, in the city, or in the suburbs? I'm thinking suburbs is not a thing. Airport or city is probably more lucrative. But yeah, need your insights on that.
So it will work, especially depending on the kind of a car. Now, if you have a bigger vehicle, I think that those go for rent easily, because that's the one people are looking for, like to rent over a weekend. Like if you have a van that can seat 5-7 people, right? But if you just have like a sedan, and if you're not offering a drop at airport, and if you stay somewhere in Leander or Pflugerville, right? I mean, you can put that, hey, you have to come to my home and pick up my car, but I think your
yeah, a lot of people,
that will
if
be
they have
very
to
low.
travel 15 miles to get to that, it may become not as enticing for them.
Yep.
Yeah. I have one question. Yeah. What about liability? Somebody, I mean, that's what worries me
Insurance
more.
and all.
Yeah, I mean, I don't want to get sued for $1 million, right? For 200, like $500, $600. So, I mean, how does the liability work? It's like, I mean, just like regular insurance. Is there a special kind of insurance for this? Can somebody set some sites on the liability side of things?
So
I think you have to register your vehicle differently, right? For business purpose.
Yeah, you should be registered. The Turo offers you an insurance. That way you don't have to use your personal insurance. And I think using personal insurance is not ethical for sure, and then maybe even not legal, I think. So if a guest damages your car, Turo is going to pay for it. Of course, they have a deductible and all, right? So that is for your vehicle protection. The liability, I assume, rests with the driver.
How much is the rough revenue and margin per month?
So in my case, I would say I do not put it for, so I stay in Leander, and I do not offer a vehicle outside my home. So anyone has to come to my home to pick up my vehicle, right? In that case, it is around 400 to 500 with Turo's commission. So Turo has several plans, and they take either 25%, 30%, or 10%, but your deductible will go high if you pick a lower plan. So I have the 25% where they give you 75% of the earnings, they take 25%, and they offer you a $250 deductible plan.
And
Thanks,
then how
answer my question.
How does it sums up in your total tax return? So probably, obviously, I mean, we might be earning more, but probably if we are going to pay higher taxes and amortization on that, but might be a future question, not right now.
Yeah, I don't know that. I've not filed, and again, it's like, I mean, they give you a 1099, right? So you're gonna have to do that.
Taxes are taxes. I mean, wherever you make money, you're gonna pay, regardless whether it's a Turo event or DJ or anything. So yeah, it doesn't matter.
So 500 is a revenue or profit?
I would say profit.
So after giving 25%, this is what comes in your hand.
After giving 25%, yes.
I mean, approximately give or take, right?
There's the wear and tear on the vehicle, mileage on the vehicle is not counted, I believe.
And
yeah,
then,
I'm not counting the mileage. I'm not counting
Okay.
like with the wear and tear that comes with the vehicle.
And Sachin, for how much time in a month, like the vehicle is rented out? Like you get 500 in 30 days, or it is like 15 days, or you just rent it out just for only 15 days, and for last 15 days you say no.
No, so I have two cars. That's why I put one out on rent to just check how it worked. Right. I put this only for like 4 months, so I'm by no means an expert. I should have clarified this in the beginning. Okay, I've been put here only for 4 months. So no, the way I have a van and I put that. So the way I see it go is usually it doesn't go for 15 days. I mean, if it goes for 15 days, you'll make a lot of money. Okay, definitely 1,500, 2,000 range. So. Mine goes for weekends, 3 days, 4 days. If you get 2 rentals for 4 days on a van, usually you're making 500, which is for 5 days or 7 days on an average.
And how does it compare? Like Turo is like cheaper than the Hertz and Avis, those bigger rental companies. Why will people come to Turo? I mean, that's just my thought process.
Just like Airbnb, right?
Yes.
Like hotels versus houses. So someone finds it more convenient. I mean, it's apples and oranges kind of.
And also, I think it's also cheaper now. It is also, I think, at least in Austin, it is cheaper if you book a van in Enterprise or something. Sometimes you don't even have that in Enterprise. Like you'll not even be able to find out if you're booking for on a Friday for like Saturday, you'll not find it. Turo, most likely you will.
And typically when you do some of the services like Airbnb or Turo rentals, you don't plan for 30-day rentals. You probably plan like 7 to 10 days on average to be occupied. So approximately 10 to 15 days. So not more than that. So you may be a little conservative, you may be 7 to 10 or 15 to 18, but you'll never have 30-day occupancy or 30-day rentals typically.
Sachin, 5 to 7 days in your case for 500 per month?
7. Yeah, you can put 7 days. Yeah, you can put 7. 7, and but that's also again, like I said, because I do not offer any pick and drop.
Okay.
Yeah, and especially airport. If you do airport, I think you'll get much more.
Much more. Okay.
Okay, cool. This is good information.
Yes.
Got a quick question. So does Turo vet the customers, or do they take any responsibility in case there is any, say, theft or some illegal thing going on? How do you like safeguard yourself if some such thing happens?
So for like I'll talk about two things separately. One, your vehicle, and the other, the person doing crappy stuff. So for the vehicle, you are insured by Turo. So most probably, I mean, in my interaction, 2 people, one Indian guy, he was very nice. Actually, I went and dropped the car to his home, which I generally don't. And after he cracked my windshield, he stopped taking my phone. So you should always be prepared to that people will not pay you in the case of a damage, and they'll be good to you until there is a damage. So Turo takes care of the liability at least, right? So I think you're covered there. Now, like if your drug dealer is renting your car, well, then you have to deal with it. And that's why I said you should figure out a way to filter out your people who you're renting to, like look for their past reviews. What is their like Turo has a 2-way review system similar to Uber, right? Where they review your vehicle and then you review them. And then I usually look for people who have some reviews. If they have anything less than 5, actually I would not rent it to them, because I mean $200 is not worth that hassle for me.
Gotcha. And is there any like background check services available, or are you allowed to do that outside of Turo?
I don't think you can. You can ask the person, but I don't think they will. It's like Airbnb only, right? You can't ask for the
Turo website has they listed how it works and all. I think they clearly explain.
Okay. Yeah.
I don't think they do any intensive background tests and all. It's just they look for your license.
And I think most of these social sharing services, they try to avoid showing the last name to avoid discrimination. So I don't know whether Turo does it, but yeah, they do background, or they claim to do it, but it's never good enough. Like Airbnb, you have parties or some shootings, crazy things happen. So again, they don't vet as much as an employee. It's just they do kind of like a rudimentary vetting.
Got it. Okay, thank you.
All right, guys, what else other than what other gigs or hustles? Airbnb, most of us know.
Like real estate agent on the side. Yeah, I'm doing
Yeah,
it.
notary, real
in
estate
Detroit.
agent, runner city. Again, they don't make a whole lot of money, but again, weekend someone has a permit.
Runner city, those guys make $30-$40 per hour. So.
Yeah. I mean,
what is runner city?
That's a Facebook group for doing odd jobs, like including bringing sandwiches or to like electrical work or gardening or mowing or something. Again, or picking up. Even if you have a truck and you can help people pick up TV or something from Costco, they get paid. And if it's a truck, it's like $50. If it's just and that's the minimum. And if it's just a handyman, and if it's just a person, labor, it's $30 an hour. But people typically pay more than that, like $10 more than what the minimum is.
Basically, you hire for hourly basis. Could be moving a treadmill upstairs.
Like on-demand service, yes.
Yeah,
exactly.
exactly.
So good to know.
It's an hourly. It's a Facebook group, I think. I don't know. If
Yes, it's a Facebook group.
Yeah,
and
it's
I
a
think they're
Facebook
doing an application.
Local, right?
But yeah. But the challenge is, if you are in the suburbs, they ask you to start paying when they leave the house somewhere an hour away. So it gets a lot more expensive than being in the city.
Yeah,
I know.
So, all right, I think we have a good list. I think, to me, I think Runner City, realtor. I don't know. Is it right now? Is it a good time to become a realtor?
So once you become a realtor, right, licensing agent, you have to keep up board membership and all. You have to spend anywhere between 2,500 to 3,000 per year. But if you get 1 or 2 clients per year, of course,
even
you have
one
to
client will make the money back.
One client, 2 clients by word of mouth.
Mm.
That's good, but it depends. Sometimes, depending on the client, you have to spend 5-10 hours versus 40 hours, and one client 2 hours you are done. And then once that deal closes, depending on how you agree with that client, you may make good money.
And again, if you are an investor yourself, it'll
in my case, I'm an investor myself too.
Exactly.
So you can rent, buy your own.
So what's the deal with notary? That's something which is pretty intriguing, because the person who came to me on notary, I thought that she got 200 pages signed, and I think they get $1 or $2 per page. So that's pretty.
No. Again, if you go to a bank, it's free. If you go to some of these UPS services, you pay like $2 or $3.
No, I'm talking about mobile notary, people who come to your houses for.
Exactly. Yeah. So they come to the houses. So even when I sold my house, I did a remote closing, and then I had to pay around $200. I think, I don't remember exactly. And the notary came to the house. It was 2 hours for him, or not even 2 hours actually. When you're a seller, you just need to do like 10 signatures than a buyer. So he just came in for half an hour, 45 minutes, and charged like $200. So yeah.
So that way, so let's say if you have a contact with some of the good title companies, right? Then you don't do anything fancy. You just do, some fundamental work. An hourly ROI basis is pretty good, right?
Right.
So I'll tell you this. I do just recently started doing notary, and I used to get things notarized. UPS charges $6 per page, right?
Yes.
And if you're doing an average closing, that is typically like at minimum 5 to 5+ pages. If like the other person was saying, like if you are traveling, then yes, you get real good money. But now, provided depending on the client, on the time, and when you're available to get there too. So you have to be a complete mobile for that.
Again, it's on the side, right? Like you're not banking on it as something, a couple of $100 here and there. So maybe you do like 300 to 400 a month, but again, you're spending just a few hours a weekend or something like that. But yeah. And it's relatively, I haven't done it myself or researched it much, but I believe what I heard was it was pretty easy to get a notary. And the other one would probably be like a lot of people would do like insurance and not the MLM kind of services, but they're like doing wills, etc. Those are other areas too that you can make money by providing financial planning, etc.
Kunal, Fiverr is very popular site, right? Fiverr, you know Fiverr?
Yeah.
This is amazing. If you are good at graphic design, resume building, resume counseling, logo design, the essay writing, you're expert at that. You can sell those services there. You can even buy and then resell, and it's music. You can create a radio advertisements, all kinds of stuff. Fiverr is amazing. So Fiverr is work from home type thing. If you have that skill, you can sell it on there.
Can you spell it?
That's the right spelling.
F-I-V.
Is it this
Fiverr,
or this?
No. You had it right. You had it right before.
Yeah, it's Fiverr. Very popular.
There are people
stock
who
too,
make
right?
300 to 500K on Fiverr, just doing like millennials, or what is the next one after millennials? The people in their 20s.
Gen X.
Gen Z. Yeah.
There is,
Gen Z.
Nimish Bhai, there is TaskRabbit too.
TaskRabbit.
Yep. That's like Runner City, yes.
So yeah, if you have a specific skill, you can sell in Fiverr. It starts with $5, but most of the rates are much higher than that. So, you can buy templates of resume, you can templates of Photoshop designs, and these people are from all over the world. So pretty good. All right, I think we have a decent list to work on, and if you guys have more, post it in our group. Definitely, I don't mind having a separate session just for Turo. Sachin will be the driver of the Turo project. If there's an interest, I don't think it will hurt his business because the demand is pretty high for the cars.
How is the Indian clothing boutiques in Austin? How is that market here?
Doing part-time is a huge capital cost with less returns in my mind. If you're doing part-time, then the listed here are part-times. But full-time business, I don't know.
Okay.
Yeah, we need more boutiques for sure.
I think if someone is really good at it, then technical writing pays a lot, like freelance technical writing.
Yeah, I'm
One of my
surprised.
cousin does it in India, and she makes a ton of money.
I don't see people mentioned about coding and all that, such projects, because I'm quite sure there are many projects like that. Freelance coding.
Yeah, but something with that and Fiverr is you're competing with the rest of the world. Yeah. So you're competing from people in Indonesia where it's like $1 goes a long way, So we may not see the ROI on at least the coding and Fiverr's initially until you establish yourself to come up the charts. So it's kind of like a mixed bag.
One of my friends is a product manager. And he was kind of reluctant to share, but he said that once he was once initially he started charging $50 to $80 just to make himself popular in that product management freelance, and nobody hired him. But then he said he started charging $200 per hour, and then he got a bunch of assignments. So it's also
that's right.
Yeah, so what he said was that while you might still be competing with people from Indonesia, people from India, like living in India, and all of us and most of us are Indians, but Indians in India and so on. He said people will still, value a US time zone person over the India time zone person, plus
the experience
the trust factor will be more as well.
Not only that, the experience and the work exposure that you got here definitely adds more value.
And also to add to that point, your professional profiles will help your LinkedIn, your They'll research you to come. Yeah. So, but your observation is right. Anywhere below 200, 300, they'll think you're not expert. So yeah, you need to put really high and not too high so that you'll miss some opportunities.
Yeah, I myself gotten like LinkedIn calls from like folks. I'm on H1B with an EAD, so very close to getting my GC. But like I've seen people reach out to me for guidance on marketing stuff, and they're willing to pay quite a lot. But they're not supposed to, do a side hustle on H1,
Right.
so I don't do anything. But but once I have a GC, I'm going to try some of that stuff.
No, particularly if you are a citizen and if you're expert in some IoT, automotive, or some chipset, you can demand a lot of money. I do it, but very occasionally, basing on what they want. Yeah.
Right.
So it's good money. Yeah.
All right, guys, it's almost 4 o'clock. 2 hours of power-packed knowledge, guidance from everyone. That's amazing. I think we need to do this community roundup, and someday we should all gather also somewhere, right?
Yeah.
So,
Best one on that. Yeah.
No, that will be perfect. Yeah.
I enjoyed meeting people here rather than, information is great, but meeting other people, like-minded people is definitely the best on this one. Yeah.
So I will set up the basic financial planning thing next week. I need young people because that's where that power of compounding comes. We can make a bigger difference, but everyone's welcome. So I run a TMC, the Money Club.
How can we get access to that, or how can we become a part of that?
I can add you to the group.
Let me see you. Yeah.
What is your number? I'll add it to you.
Yeah. Nimish, the only question I had was how to become a notary.
How to what?
How to become a notary person? It's like when you go to the online, it's just that simple to apply and then you get certified. How is that for notary? Yeah.
Yes, it is.
Without people on H1, L1, can they do that, or it be only for the GC people?
That's a good question.
The problem for you on H1, I can tell you that is that it's very, very tricky on, you cannot even technically volunteer on an H1 if the volunteering that you do might take away a US person's job. So be very, very careful on that. Like, let's say you volunteer in some event where, it's not truly a purely volunteer activity. It is something which is normally a paid activity. Then also you could be violating the terms of your visa. So I would say and a lot of people might not understand the nuances. So it's like a lot of risk doing anything like that. So be very careful, I would say.
I would
Thanks.
Yeah.
Thanks a lot.
Let's not pursue that fast. Yeah.
Yep. Thanks
All right,
a lot.
guys.
So for a GC candidate applying online and getting the supplies, that should be easy process, right?
Yeah.
Okay.
Only thing is, I think you need a state of Texas something, and then you need like an excellent printer, like not those cheap of $70-$80 printers. If you're going to do notary as a professional, you will need like one of those $1,200 printers which do like 50 pages a minute. That otherwise your time will be spent just
waiting for the printouts. And fighting the system. Yeah, you need the right tools for being a professional. Yes.
But the ROI will be super high on that printer.
And it's a business expense. You can write it off.
Yeah. Kalyan, Kunal is in our TMC, so you can connect with him.
Oh, okay. Thank you.
I have a question. Can I just mention it in the group, and whoever is interested in being a notary, can we all get together, please? I would like to know more about it as well.
Yeah, Lina Ben, Kalyan is in our group.
Okay.
I'll write in the TMC right now. This is Kalyan. This is Kunal. I'll introduce.
I don't do notary or anything. I just keep on researching stuff just because it is fun. I'm on H1, so I don't do anything, but I research it.
Feel free to reach out to me. This is Jay.
Jay too. Okay. Ready, guys.
Nimish bhai, can you please add me on the group?
As long as we don't advertise businesses, sure, Ujjwal.
Yes, we cannot advertise for
Yeah,
sure.
this is simply Seva, pure Seva. What is your number?
785.
Why don't you do this? Write down my number.
Sure.
And ask me, WhatsApp me or text me.
Okay.
And I'll add
Perfect.
you
I
guys.
can do that.
Arunji, you can too.
I messaged you. Yeah.
Okay. Okay.
But I can message you from my WhatsApp. So that's on WhatsApp. Then I'll message you on my WhatsApp.
One idea I have, Nimish, which I wanted to add. If you have 5 minutes, I think it would be useful for folks. So that is teaching people about SAT and GMAT. Like a lot of folks are really good at maths and GMAT. It's a low investment. You don't need to invest anything other than your mind, right? In learning the tips and tricks. Maybe it takes 3 months to learn a bunch of stuff, and then you can,
Kunal, I'll tell you one thing. Nowadays, many universities are dropping SAT, GMAT, ACT scores. You know that?
Yeah, I do.
So
they are dropping, but still it'll be quite some time before people, because it'll still be like hyper competitive. Indian kids will always take it, and just my opinion, okay? And that is because it's another way of differentiating yourself from the rest of the crowd.
Yeah. My son is doing it, but with the attitude that they don't need it, but he's still going to do it. But you know, where's the gap where we are struggling? All the high school calculus and those classes, we need tutors. And we get only tutors from India, which is a pain. So, because their style is different, my son cannot understand the accent, the time, this, that, payment. So we need a collection of tutors here in Austin.
This was actually
And those tutors actually charge a lot. Like a SAT tutor maybe.
అయినా కూడా 1 month కి renewal అంటే automatic renewal it should have done by September 14th or 15th.
Hello.
Can you mute?
Yeah. Who was asked?
Can you send your number here, Nimish?
Yeah. This is Nilesh. Somebody was asking for tutors for calculus.
Yeah, Nimish.
Yeah, you should go this site, Wisent.com. Wisent, and you can choose the professor from MIT. They charge little higher, but you do not have to get tutors from India. They get people from MIT, Harvard, or Boston College, or NYU.
Oh, wow. Wisent?
Wisent, yeah.
Okay. Oh, very nice. Thank you, Nilesh bhai. Yeah.
Yeah, very useful. Thank you.
All right, Sachin, you asked for the number 734 734-644-0928.
Okay, cool.
Okay, so we deal with retirement, financial planning, how real estate also. We are 200 plus, big group, busy group.
Sure, yeah.
So we'll help you guys with any financial queries, guidance. We have Zoom calls on that too. So, all right, cool, guys. I think this was awesome. Probably the longest session we had, very fruitful. So come up with new topics. We can do Zoom call again with those topics. I am going to do the basic financial planning next week. I'll prepare the deck. I already have some slides, and then we'll try to help the community. So appreciate everyone's time, guys.
Thank you.
All right.
Thank you.
Bye.
Thank you, Nimish.
Bye.
Thank you.